What's up, YouTube? It's Joe Catchpolia sitting on the couch, making some money, investing in fractional real estate online, as usual. Today, I'm going to go through my October results for my Mogul portfolio. We're always 1 month behind. We get paid in November for the October performance. So I'm going to go through that. I also want to go through a couple of things that they talked about in the monthly webinar. If you're not watching those webinars and you're either invested in Mogul or thinking about it, you really should be. They answer a lot of questions. Every time I watch them, it gives me more confidence in them as the people who are running the business. They had someone, they had their director of real estate, maybe acquisitions, I don't know, speaking on there. So it's not, introducing us to some other people, not just the two main founders. So it's good to see, the other talent that they have on the team. Um, Usually in the webinars, and this was no different, they drop a new property. So this was launched on the webinar. I already did a video review of this because we got early access if you had invested in them alone, because that deal fell through. But it's already sold out. It was live on the site today, sold out already. They answered some good questions about this, so I was glad. Well, they answered my questions that I had about this. So um, why the projections were lower than they were for the unit next door. The most concrete thing they said was, well, there were less bedrooms occupied when we're buying this than the other one. But then they really got into, well, we don't think it makes sense to. We're just trying to always pick a number that we think we can over deliver on. We're trying to under promise and over deliver. And so maybe with the info they have and the way these properties are running, if they put out numbers like they did on the first one, maybe they'll hit that, but they don't feel like they'll exceed it. And so, at least that's my interpretation of what I said on there. Obviously, you can go back and watch that webinar. It is on their YouTube channel. Um, and so find out more. The other thing they said is we don't think it makes sense to, because the other thing they had changed is the appreciation rate. And so they basically said, we don't think it makes sense to just peg the appreciation rate to how single family homes are appreciating in that market. We think it's going to be more of a capital markets type deal, right? People who are buying these in the future are going to be other investors. And one of the things I've talked about quite a bit, right? It's not going to be single family home buyers buying these. It's going to be other investors. Um, and so how that's going to be priced, isn't necessarily going to track with what single family homes are doing. And so having a little bit more conservative appreciation projection just makes sense. So I thought those were good answers. I still think these deals, numbers wise, I'm perfectly happy with. I do just get nervous about really going all in on this business plan, because if at some point you can't run this as a 10 bedroom, 10 bathroom, 5 bedroom rental, I don't know what you do with it, right? And so that's the only reason I've been avoiding all of these, or that's the main reason. But if obviously I put out a video on this one and the Rock House, which is the one next door. So you could always go back and look at those. There is a mobile playlist. Before I forget, please like and subscribe. In the description of this video, I have links to all the places where I'm currently investing in fractional real estate online, Mogul being one of those places. Please feel free to use those links. Some of them give you free money, some of them don't. Some of them say they will, but they don't actually. Um, but do your own due diligence on all the platforms and any property you see on any of the platforms. Just because I am not buying some of them doesn't mean that's the right answer for you. And just because I've started to trust some platforms and not so much others, you want to just dig in on your own and really understand what you're getting into. Also, in the description of this video, there's a link to the Discord that I have set up. We have about 200 fractional real estate investors in that Discord now. So a lot of good discussions about all sorts of platforms, strategies, and so please feel free to jump in there, jump in any of the discussions, share your thoughts, ask questions. It's turning into a really good group. Okay, what else did we in the webinar? When I looked at the Gruden, it is in a flood zone. I'm nervous about storms in that area, the insurance. And so one of the things that I thought was interesting they talked about on their webinar for this one is that, okay, they do have flood insurance. They do have hurricane insurance. They have part of their equity raise is raising enough for the to pay the deductibles for the insurance in case there is a storm and they have to do that, which I think is very smart of them to do. And also I believe they said a full year of business interruption insurance or rental interruption insurance. So essentially, if there is a storm and they have to rebuild, essentially getting your rent paid during that time, so that you're not missing out on that return. So I've mentioned lots of times I think they're very savvy in their approach towards insurance. Obviously, it makes me feel a little better about this. Still doesn't make me. I don't think it's enough to change my mind on this particular deal, especially just because they are lower than their average yields. And when we get into my portfolio results, you'll see the STRs have not been performing as well as the pad splits have for me. It might just be that time of the cycle though. Okay, so let's jump into this. It says I have 25,000 invested. I don't really. I really only have I've got about 2,700 just sitting there because the Malone didn't close. That money just got pushed back into my account on here. Like I said, they did give me the option to invest early in the Wabi Sabi, but I just didn't feel like it was a good fit for me. My dividends had a pretty big jump this month. Almost all came from having another property online. Let's see. So overall, in total, my annual yield has been 9.82%. This is with some zeros thrown in from some properties, and so I'm going to go into each property. But this is a great yield. I'm actually really happy with this, especially where there's some trade-offs, right? Some of it is the first month or first couple of months on some of the properties, you get above average yield because your debt service isn't due yet. You close on a property, you can operate it and get income right away, but you don't pay the mortgage that first month. And sometimes it's pushed back even a little bit more than a month. So that obviously overstates or makes your returns in that first or second month sometimes stronger than it would otherwise be. But at the same time, some of the properties have to ramp up operations, and so I think it's a pretty good trade-off. My running total 9.82%, and that's cash on cash yield on this property on my portfolio. So I'm pretty happy with that. I'd like to see it move a little bit more. You can see it's being dragged down a lot by this is the axle rod. This is my largest investment. I had bought $5,000 worth of this one when I didn't realize that they put out a property almost every week. And so I thought I'd be buying less properties and buying less often. Once I realized that I'd have the opportunity to buy a lot more, I am still just experimenting with all the fractional real estate platforms. So I didn't want to buy, have 15 properties at 5K a piece every year. I wanted to, so now I'm doing a little bit less. Um, let's see. Yeah, at the moment, I think my average is somewhere around $1,500. Trying to stick with either, somewhere between 1,000 and 2,500, depending on how much I like it. Uh, I, and really lately I've been really picky, right? So, but just trying to keep an amount that, if this all goes to zero, I'm not going to cry about it. I don't expect that to happen. I think that, I'm really impressed by their team and the way they're doing things. But at the same time, it hasn't even been a full year since I made my first purchase, so I'm trying to go a little bit slow, and just try to understand how everything works. But you can see this property, 6.15% annual yield. And I actually think this is overstated a little bit, and I'll explain why. So the last 3 months, August, September, and October, it hasn't created enough revenue to pay for its debt service. So you can see it has negative cash flow. Where'd that cash come from? Well, it came from this came from the reserves because they raised very large reserves when we get started, but they're not showing it. I don't believe that's being calculated into our cash on cash returns, right? So it's just showing up as a zero, and so we're averaging in as zero for these months instead of averaging in that negative number. I don't love that. I'd like to see exactly the right actual return without the impact of our reserves. But I'm fairly certain that's what's going on here. And I'll show you another one later that makes me think it a little bit more as well. Um, Presumably, either, one, they did raise very large reserves on a lot of these. So some of that, maybe they think, okay, we can burn some of that off and it doesn't really matter. We don't need to have it as large as they were initially. And then some of them, I think, when we have better months, maybe they'll start taking some out, and then that'll sort of even it out, right? The way that they look. But okay. The roads. This is so. This was my. I don't even know if I mentioned it. This is it's a duplex in Houston that is run as a whole property short-term rental. It's a fantastic property. They actually, this was one I was really excited about. I think it's one of the best discounts I've seen that they negotiated. So, it's too bad the yield hasn't been great. But really, even when you're averaging 3 months of zeros in there, 6% yield, it's not terrible. It's just not as exciting as I had hoped. And we'll see how the rest of the year ends up. Started off the year pretty strong, so we'll see how that goes. The roads. This is a pad split in, I think, Mesa, Arizona. This has been one of my most stable, high yielding, annual yield 11.17%. They did mention, it's been full the whole time. One tenant moved out 10/27. So, next month presumably is going to be a little bit worse. Not a huge deal. It is, how many bedrooms is this? Is this 8 or 10? 10 bedrooms, right? So one moving out, it's not going to be a big deal. It should be, as long as they get someone in there, but it is going to be a little hit, right? But 11% yield, this is fantastic, right? Anytime we're getting into a double-digit yield just from your cash flow, right? I'm very excited about that. The WAGs, it's another zero. That's because this is one there was a title issue that came up after closing. The property got foreclosed on by a mortgage holder that nobody knew existed at the closing, and so they expect that we will get refunded this, but there's an ongoing lawsuit. They don't really know until that's done, or I don't know if it's actually a lawsuit or if they're just trying to get a settlement from the title insurance company. Whichever it is, I expect to just get the money back on this one. I don't think that we're going to get any sort of return. I don't know yet, but so that's it's a zero. It's sort of dragging down the numbers, but I didn't have a whole bunch of money in that one. The Mafi, this is a Decatur, Georgia pad split. It was one that wasn't. Oh no, this one's been chugging right along, and we're continuing to have pretty solid yield. Oh, we did have a little bit of a dip, but back up to a little bit stronger. When you look at annual yields of, again, 10%, very excited about that. The Johnson, this is a Austin area, or Austin short-term rental. Uh, Again, you can just see the short-term rentals have not been doing as well. I did have a positive month though. We had a negative last month, and so this is one where, um, we took some out of the reserve last month, and then this month we have positive cash flow, and it doesn't look like they are replenishing the reserve here, right? And so that's what, it wasn't $500 either way. It's not a huge deal because, like I said, they are large reserves. You can see we did have a large OPEX, so I don't know. One of the things I'd really like to see is for them to start giving us the reserve balances, because I'd like to see when we do have a positive number to replenish that. If unless they think that their initial reserve is larger than it needs to be. But anyway, 6% cash on cash, not terrible, but definitely, the short-term rentals in my portfolio are not doing great. The Celeste, this is another Houston short-term rental. I think it's the only one that I have in my portfolio without a pool. It's also the worst performer, right? Obviously the WAGs, but the WAGs has that different issue that I mentioned. But so, now we've sunk under 4% annual yield. I don't love that. What's interesting though is it is the first negative levered cash flow. I think it's just had low cash flows. I mean, it started off really strong, and then you can see it's been sad since then. Now, all of these, they have given us memos, and they're saying, it's really just a seasonality this time of year. And so, some of these that I haven't owned as long, they didn't experience all the good months. So we'll see what happens over the next. That's why I'm just dipping my toes in a lot of these, right? I want to see how they perform, what the average is. It's why I want pieces of a lot of different ones. But I'm still trying to be selective as well. And so obviously, I mean, this one looked really good. I remember when I looked at this, it's very rare that I think a short-term rental makes sense when it doesn't have a pool. But I remember looking at the comps for this and thinking, yeah, it just does. And I'm pretty sure that it doesn't have a pool. I'm not confusing it with another one. Anyway, the Victor, this is another pad split in Atlanta. I mean, this is, I wish I had bought a lot more of this one, right? It has just been pumping out strong returns. You can see, okay, we did have a down month in October, right? Monthly yield. But even if you annualize that yield, we're still getting a good return. One tenant moved out on 1010, and they're trying to get someone back in there. It's kind of interesting though because last month there it was already down, but no memo. So I don't know if there was a discussion about that one or not last month. The Andres, this is one that has had a little bit of issue with tenants moving in and out. Um, yeah, and somebody's yeah, one tenant missed 2 weeks worth of their rent, but it's since been paid. Um, so you can see, we had some bad, relatively bad months. I mean, still not terrible months, but not as great. But a lot of catch up here in October, and so I think that this higher number reflects partially that they got paid some of the money from these other months. But anyway, back into the double digits on this one. You can see the pad splits. That's the story, right? All the pad splits are yielding pretty well. The short-term rentals not quite so well. We've had that discussion quite a bit, though, that I think the short-term rentals are properties that will probably make more on appreciation with, and the pad splits, really the yield has to do most, if not all, of the work because they're just not properties that I think are going to, experience the same level of appreciation. I also think during different parts of the market cycle, short-term rentals could do really well if we have, right now if we're not in a recession, we're definitely looking at one, or sometime in the near future. Um, that obviously affects people taking vacations and whatnot. Um, where pad splits, it's affordable housing, and so you think, okay, that should actually be helped by a downturn, right? And so I think at different points, some, the different business plans will do better than the other. But I'd like to have both in my portfolio because I'm thinking about having this for a long period of time, right? The Chelsea, this is another pad split. I think this is another one in the Atlanta area. Yep. Uh, Fantastic numbers across the board on this one. Just not. Again, it's another one that I just wish I had bought more of, And so over time, these are the ones that I really like for the pad splits. They're the single family homes that were converted to pad split. That in the future, if they need to be sold as a single family home again, it's not going to be terribly difficult to convert back. Versus when I was talking about those 10-bedroom, 10-bathroom purpose built pad splits, I just get nervous about those. So you see, most of the pad splits that I've bought have been these home conversions, not the purpose built ones. I think if you started having some purpose built ones that I could somehow imagine being converted to a single family home, I'd have a different view of it, right? But they are technically single family homes, but I think you know what I mean. Okay, let's see. The Ratliff. This is another. Which one? Where is this? This is in Douglasville, Georgia. Pad split. Um, this one's been doing pretty well. You can see it is. It's. I think it was July the first month. Yeah, July was the first month, and so this was, had the benefit of no debt service, so we had really good. And then, we've actually been trending down. Um, and let's see, I think this has been an occupancy issue. Yeah, one tenant moved out on 1010. Room wasn't filled until November. Another room was vacant until 1015, and then the tenant moved out 10 days later. So, basically counts as vacant the whole time because pad split takes the first 10 days of revenue. They're working to stabilize it. Despite that, we're still getting a decent yield, right? And I mean, this is the yield. You annualize that, yeah, you're not going to be super excited about that yield, but it is, you're easily covering your debt uh, when you're having some occupancy problem. So it's good to see that. Obviously, I'd like it to be performing like the others, but having this is part of the reason why I want a bunch of these, right? Because I think on average, our yields are going to be really great, and probably, if I want my average yield to move up, I need to invest in more of the pad splits and less of the short-term rentals. Honestly, I'm pretty happy with the 9% cash on cash at the moment. I'm not trying to live off this income. I'm just reinvesting it anyway. And like I said, I think that on average, the short-term rentals will experience more appreciation just because of the nature of the properties, the locations, and whatnot. Uh, So I don't know. I'm just going to keep doing this and keep sharing the results, and we'll see. And again, remember, just because this is the way I'm handling it, you can have a completely different approach. I know there's some people that want to pick one property every once in a while and really go all in and put a big chunk, and there's people that are just buying a little piece of every single one. I think there's all different ways that you can make this work because, on average, I like the deals that they put out. Obviously, you want to do your own due diligence on the platform and the properties and make sure that you do too. But okay, let's see. What do we got? The Ven. This is, yep, it's another pad split in Lilburn, Georgia. It's one that's not doing as well. It started off super strong, but again, that was a no debt service month. But I'm saying it's not doing as well, but it is, it's coming back a little bit, but it's covered its debt in every single one of those months, which is good. Yeah, one tenant moved out on 10/12, and they placed a new tenant at the end of October. Before that, yeah, it was ramping up. The occupancy has stabilized back to 100, but their fee structure hurt them that month, right? So the way that pad split takes the first 10 days. So again, not amazing. Average. We'll see how this goes going forward. And then the Hugo. Let's see. Yeah, this is a short-term rental in Dallas, I believe. Yeah, short-term rental in Dallas. It is, it yeah, it did have debt service this month, and also this was the first month of income, and it's a negative, right? So we have, but again, it shows a zero, not a negative. This is just not the best month to have your first month of operations, so not great. And then the Pinkman, this is another. This was one I was really excited about. It's a pad split in Atlanta, but it's one that was really like a value add deal where they did some, had the seller do some work to it prior to closing. You can see though, there's no debt service either of the first 2 months. They did, have some OpEx that they spent each month. Don't really know what those entail, but yeah, I mean, fantastic returns. Obviously, it's not going to stay that strong because once they have some debt service, it's going to go down. But very happy with how that's performing so far. The Gilmore, this is, yeah, in Tempe, Arizona, an 8 bedroom, 4 bathroom pad split. Um, yeah, again, doesn't show debt service either month. The September was just a stub month. It didn't have the full month of operations. Yeah, it closed at the end of September, but had a little bit. Yeah, reflecting less than a week. October, I mean, just an unbelievably high number, but it's because there's no debt service. Looking forward to seeing what this looks like when there is some debt service there. And then the Swift is, I'm not going to get my first dividend on this one until December. This is one with, uh, it's a short-term rental in, where was this one? Glendale, Arizona. It's one I'm pretty excited about. It has all the bells and whistles. It is a relatively small short-term rental, um, but it is, it has the pool. It's got just also, all the amenities that you could hope for. So I'm pretty hopeful that it'll do well, but we'll see. Again, maybe not starting off at the best time of year, but that, one of the things I've noticed, a lot of the people who are looking at these fractional deals are much more short-term thinking than most real estate investors, because we have a lot, especially like on Lofty, for example, because you're getting daily rent. People are just, it really shifts the thinking to short-term thinking for a lot of people, more so than I think it should. Even this though, like, because I can easily calculate my total returns every single month, um, there's that pressure to like want to perform every month. But it's just, especially for the short-term rentals, as long as the end of year average is, I'm happy with. That's all that you can do because there's going to be seasonality. The pad splits, I think, will have a little bit of that. You'll have some, certain times of year where you'll have more turnover than others, and that turnover is pretty expensive because of the leasing fee that pad splits charging, that first 10-day fee. But you can see these yields have they've just been, my annualized yields have stayed strong. We did have a dip. But like I said, I think especially early in the year, it was very heavily weighted towards the Axelrod. I had, at a certain point, it was 100% or most of my portfolio, like 90, and then it's slowly moved its way down. What is it right now? But I mean, it's still 22% of my portfolio, and it is, one of the worst performers. Um, it doesn't, that's not great for figuring out averages. And then I was buying just little tiny pieces because I was like, "Ooh, I'm going to buy every single one." But then I started to see ones, and they're like, "Okay." I started passing on more and more. So I don't know. I think 2,500 is going to be my set chunk for a while. And then I know I should have went about this in a more deliberate and measured way, but I haven't. And so sorry about that. But I think I'm getting a broad enough broad enough slice of their properties to give you a good idea of how things are going. I mean, generally pad splits are doing much better yield wise. One of the things that will come up relatively soon, as I've held some of these for over a year, I believe they're going to start doing some uh, new appraisals on these, and we'll see if we've had some appreciation. So far, I only have one that shows property appreciation, and that's this one, the roads. I'm not actually sure how this came about, why they showed that on this one and not on others. I think at some point they said that there was an appraisal done, and that's what got us there. Oh, what happened there? Jumped to the wrong thing. But other than that, we're not seeing that. Obviously, it hasn't been a long time that I've held any of them, so I don't expect any huge change. But especially on some of them where, and some of them could go down, right? We might have overpaid for some, but some I think we got a pretty decent deal on. So we'll see. We'll see how that goes going forward. Although I think the Malone was actually one that I was excited about the price, and then so that one fell through. Anyway, that's how my portfolio is doing. Feel free to jump in the Discord or in the comments to this video and share how what your experiences look like. Um, I'm sure, I know there are some other properties that are doing really well. I think there are some others that are doing not as well. But I'm curious how everyone's doing with all that. And that's it. Until next time, I'm just going to keep making mistakes so that you don't have to.